Hello friends, once again welcome back to ICA International. Today's class we are going to discuss about income tax law and the basic concepts regarding the income tax law. And let's move to the class. So what is basically a tax? Tax is a fee charged by a government on a product, income or activity. Okay, so it's a government charge on a particular product, on our income, on our activity, some activities. Okay, there are two types of taxes, that direct taxes and indirect taxes. And if tax is levied directly on the income or wealth of a person, then it's a direct tax. If the tax is levied on the price of a good or services, then it is called an indirect tax. So what are the examples of a direct tax? Income tax, wealth tax, because we are paying the tax directly to the income tax authority, which is based on our income or wealth. Okay, so it is known as direct tax. And what is indirect tax? Examples I have given the excise duty, goods and service tax. These are indirect taxes, that we are not paying the tax directly to the authority but through some mediaries. So if we are purchasing a goods or product from a market, we are paying the price for that product, but that price includes the tax. Okay, so that is the indirect way of tax. So in the case of indirect taxes, the person paying the tax passes on the incidents to another person. Okay, so this is known as indirect tax. And the pure meaning, basically what is tax means, and basically it is the charge given by the government on a product, income or activity. And there are two types of taxes, direct and indirect taxes. Now, why these taxes are levied, why we should pay for our income, for our wealth, or the product we are purchasing for our consumption? Because for levy of taxes is that they constitute the basic source of revenue to the government, and revenue so raised is utilized for meeting the expenses of government, like defense, provision of education, healthcare, infrastructural facilities like roads, dams, etc. So why these taxes are levied? Because it is a basic source of government for making the many functions the defense, education, healthcare and all. So the tax income is used in these areas, so that can serve the society better or serve the society well. So it is very fine that we are paying the taxes, that if we having income more than a limit, then the government will charge a tax on that extra income, and that will go to the society or the needed section of the society, like healthcare, education, infrastructural facilities. Okay, so this is why we are paying the taxes. And an overview of income tax law in India. Income tax is the most significant direct tax, and the income tax law in India consists of the following components. What are those components? Income Tax Act 1961, Annual Finance Act, Income Tax Rules 1962, and circulars or notifications and legal decisions of courts. These are the main components of income tax law in India. And the most important one is that Income Tax Act of 1961, and you can also keep in mind the Income Tax Rules of 1962. But be vigilant, Income Tax Act is 1961, but Income Tax Act passed or established in the year 1962. So maybe questions, objective type questions may ask from that areas, because it's little confusing, that's why. And what is Income Tax Act of 1961? The levy of income tax in India is governed by the Income Tax Act 1961, and this act came into force on 1st April 1962. So Income Tax Act is governed under means in which year? 1961, and this act came into force on 1st April 1962. The act contains 298 sections and 1014 schedules. So what this saying, 14 schedules. The act contains 298 sections and 14 schedules, and it came into force on 1st April 1962. And the act levy of income tax in India is governed by Income Tax Act 1961. And these undergo the change every year with additions and deletions brought about by the Finance Act passed by the Parliament. So we can say that these provisions and these laws may be changing every year. The rate and all will be changing in every year. In pursuance of the power given by the Income Tax Act, rules have been framed to facilitate proper administration of the Income Tax Act. So, in pursuance of the power of the Income Tax Act, rules have been made to administer these these act and laws. So, income tax rules is 1962. And levy of income tax, we are going to discuss how to levy or which are the persons, and apart from persons, who are the means a person includes what is the wider definition of a person in case of income tax law. So income tax is the tax levied on the total income of the previous year of every person, and it is the levied on the total income, but not on the current year but on the previous year. And I will discuss you some important terms which are related to the income tax. So most importantly, a person includes an individual, Hindu undivided family, that is HUF, association of persons, body of individuals, a firm, a company, and artificial judicial person. So how many are there? 7. A person includes 7 elements, that is first one, an individual, and second one, Hindu undivided family, and third one, association of persons, and fourth one, body of individuals, that is BOI, and a firm, company, and artificial judicial persons. So we have to levy the tax or the income tax on these persons. So what are the important terms with regard to income tax law? Assessee, assessment year, previous year, residential status, gross total income, deductions, and total income. We will discuss these all terms in detail. First point, assessee. Definition of assessee. Section 27 of Income Tax Act says the definition of assessee, and as per section 27 subsection 7 of the Income Tax Act of 1961, unless the context otherwise requires, the term assessee means a person by whom any tax or any other sum of money is payable under this act, and includes person in respect of whom any proceedings under this act has been taken for assessment of his income, and deemed assessee under provisions of this act, and any person deemed to be the assessee in default under any provisions of this act. So who is an assessee? Assessee is according to the section 2 subsection 7 of Income Tax Act, and he is any person unless the conduct otherwise requires. The term assessee means a person by whom any tax or any other sum of money is payable under this act, and it also includes person in respect of whom any proceedings under this act has been taken for assessment of his income, and deemed assessee under provisions of this act, and any person deemed to be an assessee in default of under any provisions of this act is known as deemed assessee. So this is known as assessee. So whom on whom we are making the tax or who is liable to pay the tax. Now we are moving to the assessment year. What is an assessment year? For example, I can give you the current assessment year is 2020 and 21. What does it mean? Assessment year means the period starting from April 1st and ending on March 31st of the next year. Okay, so on that basis, on the transactions we made in that previous year is taxed on the assessment year. So assessment year means a period starting from 1st April to March 31st of the next year. Okay, so what will be our previous year? The financial year immediately preceding the assessment year. So the assessment year currently it is 2020 and 21, and the previous year is 2019 and 20. It is immediately preceding the assessment year, and it will start on April 1st and 31st March. So this is assessment year and previous year. Hope you got this. Now we are moving to residential status of individual. Who is a resident, or who is not a resident, or who is a resident but not ordinarily resident? This is very, very, very important in this area of income tax law. So be vigilant. Who is a resident? The world income is taxable in India. Okay, so resident is his all income is taxable in India. A resident is who is residing inside the India, the country India. Okay, there are some conditions for residency that I will discuss later. Okay, so resident and non-resident means only income arising or accruing in India is taxable in India. In case of resident, whole income is taxable in India, but in case of non-resident, only income arising in India is taxable in India. And the third category, that is resident but not ordinarily resident. He is resident but he is not ordinarily resident. Income accruing or arising outside India may also be taxable in India. This is the case of resident but not ordinarily resident. So what are the residential statuses of individual? Resident, non-resident and not ordinarily resident. Who is a resident? On the basis of stay in India computed separately every year, if he satisfies any of the following conditions. First condition is that he is in India for a period of 182 days or more in the financial year. So who is a resident? If who satisfies any of these basic conditions. Okay, the first basic condition is that he is in India for a period of 182 days or more in the financial year, and he is in India for 60 days or more during the financial year and has been in India for 365 days or more during 4 previous years immediately preceding the relevant financial year. Okay, these are the two basic conditions. If he is a resident, he should satisfy any one of these basic conditions. And what is the alternative conditions? He will be a means he will be a resident and ordinarily resident and ordinarily resident. Okay, I have represented by R or R. Don't be confused with that term. Okay, so who is a resident and ordinarily resident? If he meet the both of the following conditions and he has been a resident of India in at least 2 out of the 10 years immediately previous years, 10 previous years. Okay, he has been a resident of India in at least 2 out of 10 years immediately previous year. And the second condition, he has stayed in India for at least 730 days in 7 immediately preceding years. Okay, so therefore if any individual fails to satisfy even one of the above conditions, he would be an resident and not ordinarily resident. So who is a resident and ordinarily resident? If he satisfies any of the basic conditions and he satisfies both of the alternative conditions. And who is a resident and not ordinarily resident? If he satisfies any of the basic conditions, but he he is not satisfying the two both alternative conditions, and he is known as resident but not ordinarily resident. If any individual fails to satisfy even one of the alternative condition, he would be a resident but not ordinarily resident. Okay, now we are moving to the important terms with regard to the income tax law. Gross total income. What is a gross total income? It is the individual's total earnings before taxes or other deductions. So gross total income is the total earnings or an individual's total earnings before tax or without paying taxes or other deductions. And what is meant by deductions? We know that what is deduction, right? By word meaning we know what is deduction. But in income tax law, deduction, the term deduction have a high prominence. What is deductions? Tax deduction refers to claims made to reduce your taxable income arising from various investments and expenses incurred by a taxpayer. Thus, the income tax deduction reduces your overall tax liability. Okay, so deductions help us to reduce our overall tax liability. And what is total income? So deductions, hope you got this. If we having a deduction of 10 rupees and after that amount from gross total income, if there are some deductions, we will get the total income, right? So what is total income? Your total income is your gross income from all sources less certain deductions such as expenses, allowances, relief, etc. So what is deductions? Includes the allowances, relief, rebates and expenses and all. So gross total income minus certain deductions is equal to total income. And what is an agricultural income? In India, agricultural income refers to the income earned or revenue derived from sources that include farming land, buildings on or identified with an agricultural land and commercial produce from a horticultural land. And agricultural income is defined under which section? Under section of 2 subsection 1A of the Income Tax Act of 1961 or 62. It is 1961, and 1962 the act passed. Okay, and according to the section, the agricultural income generally means these are the definitions given in that particular income tax law. Okay, any rent or revenue derived from land which is situated in India and is used for agricultural purpose. And second condition, any income derived from such land by agricultural operations including processing of agricultural produce so as to render it attributable to a farmhouse subject to render it fit for the market or sale of such produce. And the third condition is any income attributable to farmhouse subject to satisfaction of certain conditions specified in this regard, the section 2 subsection 1A. And the last condition means we can say that what is defined the agricultural income, any income derived from saplings or seedlings grown in a nursery shall be deemed to be agricultural income. So the section for agricultural income in Income Tax Act of 1961 is section 2 subsection 1A. Okay, and what is a casual income? Casual income means any receipts which are of casual and non-recurring in nature. For example, income earned by way of winnings from lotteries, it can't be reoccur, right? and races including horse races, crossword puzzles, etc. These are casual income, and casual income is chargeable under the head income from other sources under section 11(5) BB of Income Tax Act of 1961. And you have to pay tax on casual income and okay, income at a flat rate of 30 percentage, which after adding the cess the amount will become 31.2 percentage. And what is total income and tax payable? What are the steps included for calculating the total income? Income tax is levied on an assessee's total income. Such total income has to be computed as per the provisions contained in the Income Tax Act of 1961. And let us go step by step to understand the procedure of computation of total income for the purpose of levy of income tax. So what are the steps for levying the income tax or the tax payable? Step 1. Determination of residential status, that we have already discussed: resident, non-resident, and resident but not ordinarily resident. And second one, classification of income under different heads. Third one, exclusion of income not chargeable to tax. Fourth point, computation of income under each head, clubbing of income of spouse, minor child, etc., set off or carry forward and set off of losses, computation of gross total income, deductions from gross total income. Then we will get the total income and application of the rates of tax on the total income, and then we surcharge and education cess and secondary higher education cess and advanced tax and tax deducted at source. So what you have understood, first of all we have to determine the residential status, then we have to classify our income under different heads, that is income from salary, income from house property, income from business and profession, income from capital gain, and income from other sources. So we have to classify the income under different heads. And the third step is the exclusion of income not chargeable to tax. Okay. And fourth point, computation of income under each head, that is the four heads. Okay, not four heads, it's five heads: income from salary, house property, business and profession, capital gain, and income from other sources. And clubbing of income of spouse, minor child, etc., set off of carry forward and set off of losses. Then we will get computation of gross total income and deduct the deductions from the gross total income. Then we will get the total income, and then application of rates of tax on total income. We have to calculate the tax based on this total income, and surcharge also have to be applied, and education cess and higher secondary education cess and advanced tax or tax deducted at source will be given. So this is total income and tax payable, and this is what I mean to take for today. Thank you so much for listening me this much time, and hope you got all these points thoroughly. And this is very very important area of income tax, and please do subscribe our IC International channel, that is www.icinternational.in, if you find this video really helpful. Thank you.